In this video, we're going to talk about Senseonics. If you're considering buying Senseonics shares in your portfolio, then please keep watching this video until the end, because it covers many of the factors that should be considered regarding buying, holding, or selling the shares. During the most recent trading session, the stock opened at $3.61 and closed at $3.51. The lowest point at which it fell to was $3.38, and the highest point it rose to was $3.70. Compared to the current price action, its 52-week low was 35 cents, and the 52-week high was $5.56. The current trading volume of Senseonics is 17.1 million shares, compared to the average volume of 31 million shares. The current trade volume is relatively low compared to where it has been in the past. I think that the stock is still in the phase of recovery and consolidation, with most of the markets on the sideways, wondering when that's going to happen and what's going to happen next. Let's take a look at the difference between the company's market cap and its enterprise value. Basically, the market cap is the sum of the price of all shares publicly traded, and the enterprise value is the value of the company once the debts are paid off. We can see that the market cap of the company is $1.5 billion, while the enterprise value is $1.4 billion. The difference between the two values show that the market is still looking favorably at the company's future by willing to pay a premium over what the company is currently worth. I would say that the difference isn't very significant, and this means that the valuation of Senseonics is still relatively reasonable. Now, let's talk about the number of shares the company currently has, and the shareholder composition as of the latest data. The total number of shares outstanding is 428.1 million shares. Amongst the total float, insiders hold 10.8% of them. We should also look at the percentage of shares owned by institutional investors. In that case, institutional shareholders hold 20.5% of total amounts outstanding. There are 82 million shares that have been shorted, which represents 19.2% of shares traded. Essentially, the ownership composition of Senseonics is quite classic compared to other companies within similar sectors, where the majority of shares are within the hands of retail traders, but with a considerable inside and institutional participation as well. This means that the financial sector's assumption regarding Senseonics is that it does have a disruptive potential in the medical field and can grow to a much larger company compared to where it is now. Senseonics is still currently in the midst of a rebound or a recovery from the sell-off of past few months, especially when we look at things from a time scale of 12 months. However, when we switch to the multi-year backlog of data available of Senseonics since it went public, we can see that the current price level is relatively close to where its peaks are over the past 5 years and more. Of course, there are significant developments this time for the company's key products as we speak, and those advances may suggest that it can begin generating operating cash flows in the near future. So keep that in mind. I think it's material. My recommendation for Senseonics is to buy the stock at the current price level to the extent that you're comfortable at losing it, because to be honest, we're at a relatively high price level right now. And to leave at least another 5% of your portfolio for the scenario of the stock correcting lower. The trade window to consider should be 6 to 12 months at a profit target between 30 to 50%. The last element to consider would be the overall market sentiment in the financial market. The current reality is that investors and money managers are not willing to blindly follow companies to throw in their money anymore, unlike much of 2020. There are many reasons why investors are now shying away from the innovative and disruptive stocks. Some will say that they were overpriced, others that they were overbought, or that they were relying on selling dreams instead of having solid financials. But the reality is a simpler one. People began to sell their shares at one point in order to lock in their profits, which created a domino effect with significant sell-offs in the market across the board. Those companies are not necessarily bad, but they just had more sellers than buyers. That triggered a torrent of sell-offs from February this year onwards to nowadays. The overall tendency at the moment is that those stocks are now bottoming out or recovering, but investors are generally speaking more skeptical than before, and I believe that only companies with robust financials or ideas may survive. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.